4 years ago, the safest part of most people's retirement portfolio had the worst year in recorded history. Not a bad year, the worst ever. The U.S. bond market fell over 13% in a single calendar year. That had never happened before, not once since the index started tracking in 1976. Today, I'm going to walk you through the 3 ETFs I use instead, show you exactly how each one performed, and break down where I'd put every dollar if I were building this portfolio from scratch right now. And the part that caught me off guard, the fund most people would call the risky choice actually held up better than bonds when it mattered most. I'll show you that in a minute. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. This is what I do and why. Your situation is different. Now, if you're in your 50s or early 60s, you've probably done the math in your head more than once. You look at your balance, you think about what you'll need, and you wonder, is it in the right place? That's exactly what I started asking myself. I was looking at the classic 3-fund portfolio, VTI for US stocks, VXUS for international stocks, BND for bonds. A lot of smart people recommend that setup, and for a long time, I didn't question it. Then I looked at what BND actually returned over the past decade. Before I show you, take a guess. If you had put $80,000 into BND 10 years ago, how much do you think it would be worth today? The answer is about $92,000. $80,000 became $92,000 in 10 years. That's roughly 1.4% a year. After inflation, you barely broke even. That was the moment I started looking for something different, and what I found changed how I think about every dollar in my portfolio. My bond replacement. So here's what I did with the bond slice of my portfolio. I moved it into SCHD, the Schwab US Dividend Equity ETF. Before I show you the numbers, I want to be upfront. SCHD is not a bond fund. It is a stock fund. It will drop. It has dropped, and I'll show you exactly how far in just a second. But here's what caught my attention. Since SCHD launched in October 2011, it has returned about 13.5% a year. That's the total return, price growth plus dividends reinvested. Let me do this in real time so you can follow. Take that same $80,000, multiply by about 3.45. That's what 13+% compounded over a decade looks like. You get roughly $276,000. Now stack that next to BND. Same $80,000, same 10 years. One fund gave you $92,000, the other gave you $276,000. That is a $184,000 difference from the part of your portfolio you thought was playing it safe. And here's the kicker. In 2022, the year BND lost over 13%, SCHD dropped just 3.2%, barely a scratch. Here's the myth. Bonds always protect you in a downturn. Here's the truth. In the worst bond year on record, the dividend fund held up and the bond fund didn't. Now, I need to be straight with you because this next number matters and I'd be doing you a disservice if I left it out. In the COVID crash of 2020, SCHD fell 33%. 33%. Bonds barely moved during that same crash. So would you rather hold a fund that loses 13% in its worst year or one that drops 33% in its worst year? That's not as simple as it sounds. SCHD is not a bond substitute in the traditional sense. It held up beautifully in 2022. It got hit hard in 2020. And that's exactly why I pair it with something else entirely, not another fund, a strategy. I'll get to that in a few minutes because that's the piece that makes everything work. But first, let me show you the other fund I replaced. Why I dropped international. The second swap was VXUS, the Vanguard Total International Stock ETF. Over the past decade, VXUS returned about 9.5% a year. VTI, the U.S. total stock market, returned close to 15% a year over that same stretch. That's more than a 5-point gap every single year for 10 straight years. I replaced VXUS with QQQM, the Invesco NASDAQ 100 ETF. Over the same period, the NASDAQ 100 returned roughly 19 to 20% per year. Now, I know what some of you are thinking, and I want to be honest about the counter-argument because it's a real one. Vanguard's own 2026 market outlook projects international stocks to outperform U.S. stocks over the next decade. They're calling for about 5 to 7% annually for international versus just 4 to 5% for U.S. large caps. And in 2025, international stocks beat the S&P 500 by a wide margin. VXUS returned above 30%. So why did I still make this choice? 2 reasons. First, and this is the part most people miss, VTI already gives me significant international exposure. Companies like Apple, Microsoft, and Amazon earn somewhere between 28 and 40% of their revenue outside the United States. The tech sector alone pulls over half its sales from overseas. When I own VTI, I'm already invested globally through the companies themselves. And second, I don't need every fund to be perfect. That's the whole point of holding 3. VTI is my anchor. If growth stumbles, VTI steadies me. If international has a great run, VTI captures some of that through the global companies it holds. No single fund has to carry the whole thing. Quick question before we move on. Are you still holding international funds in your portfolio, or have you already cut them? Drop it in the comments. I read every single one. The anchor and where each fund goes. So let me pull it all together. The one fund I never touched is VTI. Total U.S. stock market, over 3,500 companies, expense ratio of 0.03%, that's $3 a year on every $10,000 invested. VTI is the foundation. It stays. Now here's the part that most videos on this topic skip completely, and honestly, this might be worth more to you than the fund picks themselves. If your spouse or partner handles the retirement accounts, make sure they hear this next part, because where you put each fund matters almost as much as which fund you pick. Let me walk through it. SCHD pays dividends that are almost entirely qualified. We're talking 95 to 100% qualified. Put SCHD in a Roth IRA and those dividends grow and compound completely tax-free. You never pay a dime on them. Not now, not when you withdraw. And here's what makes this even better. For a married couple filing jointly with taxable income under about $99,000, qualified dividends are taxed at 0% federally. 0. That means some of you watching right now could collect SCHD dividends and own nothing. QQQM yields less than 0.5%. Put that in your taxable brokerage account. Your annual tax bill stays tiny while the growth compounds. VTI is flexible, works in any account type. Now let's talk about getting more money in. For 2026, your IRA limit is $7,500. If you're 50 or older, that goes up to $8,600 with the catch-up. Your 401k limit is $24,500. With the regular catch-up for people 50 and over, that's up to $32,500. And if you are between 60 and 63, there is a brand new super catch-up. You can contribute up to $11,250 in catch-up contributions alone instead of the regular $8,000. That's straight from Secure 2.0. Let me say that again. If you're 60, 61, 62, or 63, you can put in up to $35,750 total into your 401k this year. Most people have no idea that number exists. Every extra dollar in the right fund, in the right account, compounds differently. That one move alone could save you thousands over the next decade. My actual safety net. So here's the question that has been hanging over this entire video. If I dropped bonds, what actually protects me when the market crashes? The answer is not another fund. It's cash. Plain, boring, beautiful cash. Right now, the best high-yield savings accounts are paying around 4%. That is real, guaranteed money sitting there while you sleep. No chance of a 13% loss. No chance of a 33% drawdown. And here's the math that makes it work. The average bear market lasts about 13 months. The median time for a full recovery back to the prior high is roughly 2.5 years. So if you keep 2 to 3 years of living expenses in a high-yield savings account earning 4%, you never have to sell a single share when the market is down. You live off the cash, your portfolio recovers, and you come back stronger. That's the whole strategy. That's what lets me hold SCHD and QQQM without losing sleep. Not bonds, cash I can touch whenever I need it. Here's what I want you to remember from this video. Safety isn't a fund. It's cash you can spend today and dividends that keep growing. 3 funds, the right accounts, and a cash cushion that lets you ignore the noise. If someone you know is still running the classic 3-fund setup without looking at the latest data, send them this video. It could change how they think about the next 10 years of their money. Tell me in the comments, which of these 3 ETFs are you most interested in? VTI, SCHD, or QQQM, and why? If you're building real income from your investments and want to stay ahead of changes like this, subscribe to Dividend Hustle. I break this down every single week so you don't have to.